Well, the only way you could save for a pension, you could genuinely save for a pension, would be to fill the garage with tins of baked beans and packets of loo roll, because everything else involves a transfer from those in work at the time. So if I want a car in 2050, it's going to be built by somebody in 2050. I haven't saved up a car which I then bring out of packaging and unpack in 2050. So the only way I get my pension is by taking a surplus off what's being produced, and taking it away from those in employment at the time. You can take the money out of the picture entirely, because it just confuses matters. Then you can understand that it's actually more efficient for the state to provide the pension, whereas if you do it on the basis that you're pretending that you're investing and then getting a return on your investment, and it's all done through the City of London and whatever, you're simply in a position where half the money disappears in fees and charges.
This is the MMT Podcast with Patricia Pino and Christian Riley. Hi, I'm Christian Riley and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. If this is your first time hearing about MMT, you might want to listen to our first 3 episodes for an introduction, which I've linked to in the show notes, along with some other things that relate to this particular episode. And as ever, I've linked to where you can support this podcast financially via patreon.com/MMT Podcast. Support starts at $1 a month or £1 a month or whatever the equivalent is wherever you live. And no matter what level of support you give, you get early access to all of our episodes and patron-only episodes where you can ask me and Patricia MMT questions. We're 100% listener funded. Your financial support really helps keep the show going, and your support in other ways, whether it's by recommending us to other people or just by listening and spreading the word about this stuff, really helps too. A big thank you to all of our supporters so far, and thanks as ever for the time you put into understanding MMT. Let's dive in. Welcome one and all to the MMT Podcast. I'm Christian Riley. Unfortunately, my co-host Patricia is away this week, but I'm delighted to have joining me this week convener of the Scottish Currency Group and member of the SNP Policy Development Committee, Dr Tim Rideout. Hi Tim, and thanks for joining me.
Thank you for asking me to do one of these talks for you.
So let's get right into it, and let's assume in the audience we have a pro-Scottish independence person who maybe doesn't understand the stakes as you and I see it. Why is it important for an independent Scotland to be the issuer of its own currency?
I think that's true for any country that actually wishes to be independent, and that having your own currency is one of the key mechanisms that defines the state. If you are using somebody else's currency, then you're really dependent on that other country for setting much of your economic monetary policy. So you're only sort of quasi-independent in an economic sense.
So in order to issue its own currency, quite a few institutional things have to be in place. And you've written a great comprehensive guide to the new Scottish currency. It's laid out in an FAQ format. But I thought before we get into some of those questions and answers, can you start by describing how the Scottish Central Bank will come into being, how it will be instituted, and what its relationship will be to the Scottish Parliament and Treasury?
Okay, the construction of the Scottish Reserve Bank, and I'm calling it the Scottish Reserve Bank. I think reserve is quite a common name for central banks, in that you have the South African Reserve Bank, the New Zealand Reserve Bank, Australian Reserve Bank, so forth, and it kind of tells you what the bank does, which is holds the financial reserves. So it takes about 4 years to construct. About a year and a half of that can be done prior to an independence referendum, which is really just the detailed design and planning and sort of getting to the stage where you have tender documents ready to issue for things like the IT systems and development of the payments network and design of banknotes and things like that. So it'll be about 2.5 years after the independence vote before the central bank is in a position to release the currency into circulation. Most people seem to think that there'll be approximately a 2.5 year period between a vote for independence and the actual Independence Day. So that should mean that we would then be in a position to bring the currency into circulation within a couple of months of Independence Day.
Mm-hmm. And in terms of like the legal framework, what kind of legislation needs to be passed? I mean, I know that's a huge question, but I guess we have to start somewhere.
Yeah, well, I've got a resolution which I tried to get onto the agenda for the SNP conference last November, but they didn't actually accept any resolutions. So we're trying again for the conference that's going to be coming up in September this year, and that's the principles for the drafting the bill. There'll be something like the Scottish Reserve Bank Establishment Bill that would go before Holyrood Parliament. So I've set out, some principles mostly to do with ensuring that the bank is under full democratic control at all times, and that we get rid of the fiction that the central bank is somehow independent of government. The central bank is never independent of government. It's a key part of the state. Most central banks are directly owned by their national treasury, and ultimately they do what the government tells them to do.
Yeah. I often come back to this idea that, okay, they have independence to set interest rates, but they're doing it to achieve the government's target inflation rate. So they've got full independence to do whatever they want to achieve the government's target.
Well, I also suggest that, not in the resolution, but in the sort of general principles that the central bank should be operating on, that its primary target should be similar to the US Federal Reserve, which is to maintain full employment in an independent Scotland, and that targeting inflation should be a secondary objective.
Yeah. They central banks lose sight of that, or the public loses sight of that as well. That to keep the pressure on. That there was actually two elements to the mandate, and one seems to have been overshadowed by the other.
Well, it's the only one I know of that is explicitly required to tackle full employment is the US Fed, and it does do that. In the case of the Bank of England, it has no requirement to consider anything other than inflation. And that seems to me to say a lot about the British state. And I think inflation is primarily a problem for people who have lots of money. And obviously, if you're a billionaire and you're losing 2% of it a year, that's quite a lot. The average person in employment, and if you think back to the 1970s, which I can vaguely remember, there was a lot of inflation, but people in employment, they tended to have annual fights over getting wage increases, and more or less the wages sort of kept pace, not necessarily in sync, but pretty much kept pace with the level of inflation. So that people in jobs tended not to be so affected. Obviously, anyone who's on a fixed income, such as a pensioner who had investments or something like that, or an annuity, they were completely stuffed. People who'd bought government bonds were a bit stuffed as well, because the inflation rate was much higher than the interest they got on the gilts. But as I say, primarily the people who don't like inflation are those at the top 1%, because it erodes their money, and also they tend to own the debts. It's their companies which lend us the mortgages and credit card money and stuff like that. And inflation reduces the real value of what is repaid. So I think the fact that the UK only looks at inflation tells me that the UK establishment is really interested in protecting the value of their money, not providing good quality, well-paid jobs for the average person in the country.
Absolutely. And I think an overarching criticism of that way of thinking is we really need to stop depending on central banks to do fiscal policy. Anything that happens, any crisis that comes up, the central bank seems to have free rein to do anything. And it's almost like, in the States at the moment, there's a sort of defund the police movement. And it's really because any problem that comes up in the States, like a social problem that really could perhaps do with a psychologist or a social worker or a therapist, because they just send the police in. And it seems to be, I don't know if you agree with me, it seems to be mirrored in the way we deal with any kind of real crisis. We, send the central bank in, give them latitude to do whatever they want. And all they've really got is this ability to raise and lower interest rates.
Yeah, well, raising and lowering interest rates is a bit of a waste of time.
Exactly.
It will transfer money either from asset holders to borrowers or from borrowers to the asset holders. But I don't think that's an effective way of tackling inflation, for example. or if you have a shortage of demand. If there's a shortage of demand and unemployment, then the government needs to increase its spending and cut its taxes.
Absolutely. Yeah.
And if there's inflation, then they need to increase the taxes and cut the spending.
Also, depending on where the inflation's coming from, obviously.
Yeah, well, you need to you need to look at what is actually inflating.
Yeah.
At the moment, we tend to not think of it as inflation, but the UK has had a 40-year chronic house price inflation problem. And for some reason, we consider inflation to be bad unless it's house prices, in which case it's very good. But why? Why should we have endlessly increasing house prices going up by, I just saw the figures yesterday, apparently there was sort of 9 or 10% a year increases in prices during the COVID period. Well, nobody's getting a 10% increase in their wages, so the houses are just becoming increasingly unaffordable for anyone who hasn't already got one. So in that case, you should have some specific policies tackled to address house price inflation, but not affecting the rest of the economy. So maybe some extra taxes on transactions or an increase of supply. Probably increasing the supply of houses would be one of the best things. Stopping people buying up property for investment purposes. Some sort of restrictions on sort of things like Airbnb and holiday homes.
I totally agree. And I wonder sometimes with these people that talk about QE leads to asset price inflation, those people, basically they were just disappointed that QE didn't lead to Weimar-style hyperinflation based on too much demand. And so they're looking for inflation anywhere they can find it. And they see house prices have gone up, as they always do. And they go, you see, QE was, asset price inflation. And I always think, okay, but what do you want to see then? Do you want to see the value of housing halved overnight? I just wonder what they think the solution is to that.
Well, you don't want that because that would then put lots of borrowers underwater. And
sure,
but we do need a sort of gradual deflation of the real value of houses. So in a sense, if there's a little bit of inflation generally in the economy, but we can stop house prices going up, then that is one way to reduce the real price of a house.
Sure.
I mean, it's worth pointing out, I think, that I think this seems to be in many ways an Anglo-Saxon problem in that my late mother-in-law lived in Germany, and when we had to sell her house in 2014, we only got, in actual nominal terms, we sold the house for twice what they paid for it in 1982. In Germany, the price of that house had really only gone up by the amount of inflation that had taken place in the currency. There was no real increase in the value of the house at all. And Germans just don't expect property to be, nobody in Germany buys a property because it's an investment that they're going to be able to sell for a profit, because you don't. The house more or less stays the same in real terms, has done for the almost entire post-war period. And as a result, property is, for the average German, much more affordable than it is in the UK, especially somewhere in the southeast, for example.
Mm-hmm. Yeah, no, it seems to be everybody just really wants expensive, affordable housing, basically. So good luck with that. So yeah, bringing us back to the importance of MMT to Scottish currency movement. So the idea is you will not be able to target full employment if you don't issue your own currency. Would you agree with that?
Yes, I think there's a lot more problems with trying to use sterling than just whether or not you can target full employment. I think the sterlingization plan of the Growth Commission would be a complete disaster just waiting to happen. Not particularly because of monetary policy, but because the Scottish government would be in a permanent financial crisis, even assuming that the sterlingization actually worked at all. Because I've been looking at this in great detail. So it is my anticipation, and this is simply what I've been told by commercial bankers, that if we become independent with no formal agreement with the Bank of England or the UK Treasury about sharing sterling, then Scotland would simply be disconnected from the UK payment system on or shortly after Independence Day. And the Scottish banks would lose their reserve accounts at the Bank of England. The result of that would be that the payment network in Scotland would simply cease to work. And you might be able to make a payment to somebody within the same bank as you, but you wouldn't be able to make a payment from your bank to some other bank. And things like the cash line machines would simply stop working. So the whole thing could very quickly turn into an extremely nasty disaster.
And also opponents of Scotland having its own currency, and as we see its actual sovereignty to act how it wants to politically. Opponents to the currency designed these 6 tests, which you did a great job of dismantling at a conference not so long ago. And really, those 6 tests were put in place to kind of sabotage the initiative, would you say?
I think they're a bit like Gordon Brown's tests about whether we should join the euro or not. But some of them are just a bit silly. I would say those tests either don't apply, or they're already true, or they can never be achieved. Mm-hmm. They're not really the sort of things you need to consider when you're introducing a new currency. I've got a separate list of things which you do need to consider. For example, I've been talking to a French banknote printer. They got in touch with me because they see a opportunity to supply us with the new banknotes. They were just saying earlier this week, it takes about 18 months from start to finish to get a banknote designed, tested, make sure it's going to work with all your machinery and so forth, to actually being ready to release it into circulation. So, you have to allow for the fact that even if we said, we're going to introduce a currency right now, it's going to be 18 months before we could conceivably do that. Otherwise, you end up in the Slovak position of having sort of hand overprinted existing banknotes, which is not very satisfactory. So, we need to make sure the notes are designed. We need to get the legislation sorted out. It takes 6 months to get something through the Holyrood Parliament, even if it's expedited. So, you can't start building the central bank until you've got the legislation approved. And, there's all these sort of things that are practical issues. Are we keeping the public informed about what they need to do? Are we explaining how they're going to get a Scottish bank account, what they need to do about their mortgage, all of these sort of things. They're the practical steps that you have to go through. The Growth Commission's 6 tests, I don't think they really help anyone at all.
Yeah. Often in these matters, people think, we have to think of something. We have to think of some basis. And the tests that come out of that seem to be not really tests at all, or just not credible.
Yeah, well, it's like that one about, do you have a credible central bank? Well, until you have the central bank running the currency, how do you know whether it works?
Yeah, absolutely, yeah. So with that said, let's go through your description of how the Scottish pound would come into use. I'll link to it in our show notes. It's a great Q&A format that you've done there, and it's done a lot of the work for me in writing this interview. So let's just run through it. So you start by asking, when will the Scottish pound come into use? Yeah,
well, ideally within a month or two of Independence Day. Mm-hmm. Now, I'm sure we could negotiate a short-term arrangement for that couple of months to remain connected to the Bank of England and for the existing system to continue until we're push the button on the switchover.
Uh-huh. And we sort of touched on this before, but adding it all up, how long does it take to create the Scottish Reserve Bank and for it to be ready to release the new currency?
It's about 4 years.
Uh-huh. And you mentioned in the Q&A that 18 months or so of the preparations could be done before the Indie referendum.
Well, that's certainly what I want to achieve, because I don't want to be spending 4 years after the referendum, because that then risks not being ready and having to have a couple of years using sterling, which I don't want to be in that position.
Sure. And will I be forced to convert my money?
No. It's a very important point that people changing their savings into the Scottish pound is entirely voluntary. And you do that so that the people who hold the Scottish pound are those who want to have it, and they're happy to pay for it with their sterling. And therefore, when you start trading the new currency on the foreign exchange market, you don't have anyone rushing for the exit to try and dump something they've been forced into and didn't really want. There are going to be people in Scotland, a significant number, who will be either hesitant about the new currency or not really want it at all. If you force them into it, you could have 30 or 40% of the population, tens of billions of Scottish pounds being dumped onto the foreign exchange market because they wanted to get back to sterling.
Mm-hmm. I wanted to know what you thought about this. It might be completely off topic, but recently, as part of reform measures, NatWest and other banks had to downsize. They had to get rid of a certain percentage of its business banking customers and encourage those customers to transfer their accounts to challenger banks. And so they offered small businesses one-off payments in the order of £1,000 or £1,500 to switch. Lots of people did. No hyperinflation ensued. Just, well, I didn't notice any. So something like that seems like a good option to me to entice people to open a Scottish pound account. Does that sound workable to you? Am I barking up the wrong tree there?
Well, I mean, it's something that could be done, but I don't think it's necessary. Mm-hmm. The 60% or whatever of the population that have voted for independence will presumably be fairly happy to switch at least some of their savings into the Scottish pound. For those who are dead against, I mean, is a bribe going to change their minds that they still think the whole thing's a bit of a bad idea? I don't know.
I think yes, but maybe I'm being cynical.
I don't know. I mean, it's something certainly that the Reserve Bank could consider, or the politicians could consider. But personally, I don't think paying people a bonus to switch into the Scottish pound is particularly necessary.
Yeah. Okay. Yeah. No. And also, obviously, within the MMT paradigm, the thing that drives currency anyway is the tax liabilities, which obviously it will be part of it, I guess. Yeah.
Well, I've been explicit that although adopting the Scottish pound is voluntary, or converting your savings into the Scottish pound is voluntary, the Scottish government, from the first day after the release of the currency, will be paying the wages in Scottish pounds. They will be paying suppliers in Scottish pounds. And they will be collecting taxes in Scottish pounds, and they won't accept sterling. So exactly the same as HMRC. HMRC will not accept US dollars in payment of your income tax bill.
Mm-hmm. And could you just say a little bit more about that? Just presuming we've got somebody who's interested in independence or who's very passionate about independence but doesn't quite understand that charterlist framework. How would you break it down for them?
Not quite sure I follow. What do you mean?
A sort of bumper sticker sentiment that you see around the MMT community is taxes don't fund spending. I think it's okay to say that if it's going to lead to a conversation. If you're just going to pop up on social media and say taxes don't fund spending and then walk away, leaving people scratching their heads, then it's probably not going to have the informative effect that we want, which is why, we've done many episodes of this podcast trying to get across this framework that comes from MMT, which is that the MMT money story starts with the state trying to provision itself. So therefore it lays on a tax denominated in something that nobody else is allowed to produce, an issue, and therefore it can then spend its new Scottish pounds into existence to provision itself. Does that make sense?
Yes. Although, I personally think that some MMT people don't give enough importance to tax. Tax is important, and taxation may not fund any particular spending, but collectively, if you get the economy to full employment, then your tax revenues should be balancing the spending. Otherwise, you're going to cause inflation. So you do have to collect tax. You can't just say, we don't need tax, because you do.
Yeah, exactly. But that's my whole point of saying, let's emphasize that, if you don't tax, then you don't have the mechanism by which people need to acquire your currency, and therefore...
Yeah, and the tax system also is very effective in directing people in particular directions. So
sure.
If you don't want people smoking cigarettes, then you put a tax on them, which is going to be very effective at discouraging that bad habit.
Yeah. So okay, let's get back to the frequently asked questions. Why is it called the Scottish pound?
It seems to be the most popular choice. There are other options. There was a Scottish silver coin in the 17th century, which was called the merk, which is the same derivative as the German mark, for example. There were older coins. There was the lion and a noble. But I think most people are not that familiar with those. So I think if we just call it the Scottish pound, that seems to keep most people happy.
Got it. Would people need to do anything?
Yes, they will, because what will happen is that the banks in Scotland would contact their customers probably 6 months or so in advance of the introduction of the currency. So this would probably still be maybe, say, 3 or 4 months before Independence Day. They'll just use the addresses and the sort codes to work out which is a Scottish customer. And then they'll write to them saying, introduction of the Scottish pound is imminent. You're currently a customer of ours. Would you like to have a Scottish pound bank account, debit card, credit card, personal loan, or whatever? And people will then need to take a positive step to ask for those. If they do nothing, the default position is that you just stay as you are with sterling.
Mm-hmm. And then if they want to pay their taxes, for instance, or receive payments in Scottish pounds, they're going to have to pay a fee to convert, basically, every time.
Yes, so there'll be a sort of 2-month or so exchange period where there are no charges and things are one-to-one. But as soon as the Scottish pound starts to float on the foreign exchange market, then the rates will diverge and the banks will introduce a foreign exchange charge. So I could use my sterling debit card to pay my council tax, but I'll find it's got an extra 2.5% added onto it for a foreign exchange handling fee.
Got it. And therefore, like you say in the sheet that you've put out there, that people will have to change their account and cards to have Scottish pound accounts.
Yes, I mean, a lot of people may choose to keep a sterling account, at least for a few years. And certainly if they have family or they travel a lot in the rest of the UK, might be quite sensible to keep a sterling account. We're not going to say you have to have a Scottish pound account, but people will discover themselves that it's very silly not to have one.
Absolutely, yeah. And this is the way you've posed the question. Isn't this even more complicated than the decimalisation in 1971 or bringing in the euro?
No, it's much simpler. I can just about remember decimalisation because I think I was 9 at the time. But you were going from a system of 12 pence in a shilling and 20 shillings in the pound and, threepenny bits and all that sort of stuff, to one where there was 100 pence. So the shops all had to get new cash registers, which would work with the decimal currency. All the price tags had to be changed. Every menu in the country had to be reprinted because prices were different to what they had been before. No, the pound bit was the same, but all the smaller bits were different. So there was a lot of upheaval, caused by that. Whereas in our case, the shop really doesn't have to do anything at all because no prices change. They're all, if it was £1 sterling last week, it's going to be £1 Scots this week. So no difference. So restaurants don't have to print anything different. The menus can all carry on as they are. So the only thing really that people will notice is that if they're using notes and coins, then the designs will be a bit different. So far as the euro is concerned, some people say that introducing the Scottish pound would be similar to the euro, but it wouldn't be at all because the euro was far more complicated. You were taking, I think, 16 different national currencies, all at different values against each other, and trying to bring that together into one currency. I think the Germans had it quite simple where there was 2 Deutschmarks per euro. But a lot of people, it was all fractional. You were taking 16 independent, separate central banks that trying to merge them into one European central bank, 16 different national payment systems, 16 different cultures. So the euro was far more complicated.
Mm-hmm. In your sheet, you say, we will do what happens in Canada. I'm not familiar with that. Could you just run me through it? Mm-hmm.
Well, we're the agents for a Canadian software company, for example, that makes map-making software. Uh-huh. And I've spoken to them, and they have a lot of customers in the US, obviously. And they simply have 2 bank accounts. They have a US dollar account and they have a Canadian dollar account. So if they get a US customer, then they can pay with a US credit card without any foreign exchange fees. And if they have a Canadian customer, they pay with a Canadian dollar card. And again, there's no issues. The only thing the company has to do is to periodically move some money out of their US dollar account back to their Canadian dollar account. So it's not very difficult.
Uh-huh. What about people with, lots of people with mortgages and credit cards and personal loans? Okay,
right. Well, we're leaving debts strictly as they are. So it'll be left up to people to decide what they want to do with the debt. So we're not going in saying, right, as of Monday morning, your mortgage is now in Scottish pounds. It's going to stay sterling until such time as the person who has the mortgage asks their bank to remortgage into the Scottish pound. But as part of the information campaign run by the central bank and the commercial banks, people will be advised that they should not keep a mortgage in sterling unless they're really happy with taking on a foreign exchange risk. and they understand the potential gains and losses of doing that. I know there was a period in the early 2000s when quite a lot of people in Poland decided that it was a good idea to take out Swiss franc mortgages because the interest rate on the Swiss franc mortgage was much lower than on a zloty mortgage. And that was all great and dandy until they discovered that the Swiss franc had gone up by 30% against the zloty, and suddenly their mortgage was now an awful lot more than it was when they started. So there's a distinct. You could gain. I mean, if the Scottish pound goes up against sterling, then your mortgage would be cheaper. But if it went down, it would get more expensive. So you're taking a risk, and I think only sophisticated investors or sophisticated people, people who really understand finance and the risks that they're taking should keep sterling debts. But for most people, they would be well advised to change any outstanding sterling obligations into the Scottish pound, within a fairly short period of its introduction. But they will need to, respond to their bank and say, yes, please, I would like to remortgage into the Scottish pound, and then go through the standard remortgage process. Most people are familiar with that. A lot of people have offers on their, fixed rates on their mortgage, which generally only last for 2 or 3 years, at which point you have to remortgage. So I think there's, people are familiar with that process. It's going to happen to them anyway because their sterling mortgage will expire. So at that point, they should remortgage into the Scottish pound.
What is the big picture on our debts?
Of personal debts or state debts? Personal debts. Okay.
I guess we kind of ran through what it would look like for an individual, what choices they'd be presented with. But you have a question on here about the big picture on debts, and it's about, personal debt at the macro level, I guess.
Well, the only sort of hard and fast figure I've pinned down is that there's about 75 billion of mortgage debt, and approximately 900,000 households have a mortgage. So that's about 32% of households have a mortgage. When people sort of put out sort of scare stories about, what about your mortgage? It's worth remembering that 2/3 of households in Scotland don't have a mortgage. So it's roughly sort of divided into thirds. So we've got 1/3 of households have a mortgage, 1/3 own the house with no mortgage, and 1/3 rent. So we are talking about 1/3 of households. Beyond that, I think there's something like 25 billion of credit card and personal loan overdraft type debt. And the business debts or business loans is a bit uncertain, but maybe that's another 30 billion or something like that.
Mm-hmm. And what about, how will this affect ISAs?
Well, it depends what sort of ISA it is. If it's a cash ISA, then you can keep it in sterling if you want, but I would suggest that it should be converted into Scottish pounds. Whether the Scottish Government chooses to continue to offer tax relief on something like an ISA is obviously a matter for Parliament and the government of the day to decide. I might probably favour Professor Murphy's view that the government should switch the tax-free incentives into things which would support the Green New Deal, rather than just a blanket exemption for anything. So maybe we should have sort of green bonds or something like that, which would be available through an ISA, whereas other things wouldn't qualify for the tax relief. If it's a stocks and shares ISA, it would probably stay in sterling because the stock market's in London and the investments are going to be quoted in sterling. So to the extent that you have any cash between trades, that would probably be sensibly kept as sterling.
Mm-hmm. And there's an issue about wages. You say, obviously, it depends on your employer. Is there any more to say about that other than, well, the government is going to be paying in Scottish pounds and the government is going to be taxing in Scottish pounds? And I guess it's up to individual employers whether they switch to the Scottish pound. But like you say, they're going to find that it's the sensible thing to do, I imagine. But is there any more to say about that?
Yeah, well, there's a bit over 500,000 state sector employees, so they're all going to get paid in Scottish pounds, and they're not going to have a choice about that. There's no facility for saying I prefer to get paid in sterling because the government's just not going to do that. So you'll be talking about private sector wages. If it's a business in Scotland, small or medium company, something like that, based in Scotland, then I'm sure they will start paying in Scottish pounds because that's where most of their revenue is going to be. So the issue is probably really about the sort of big national or multinational companies, British Airways or British Telecom or something like that. Are they going to start paying the wages in Scottish pounds? I think there'll be a period of a few months where some of those people carry on paying in sterling, but I think they're going to run into opposition from their employees, especially once sterling is diverging in value from the Scottish pound and there's foreign exchange fees for converting. Are people going to be happy about paying 2.5% to convert their wages into the domestic currency? Probably not. So they'll put pressure on the employers to pay in Scottish pounds.
Mm-hmm. And how would a Scottish pound affect pensions? Now, I guess we're going to have to divide this into private pensions and state pensions as well, but how would it affect pensions?
Okay, well, this was obviously in 2014. There was a lot of scare stories about if you voted for independence, you'd immediately lose your pension. But I think it's quite likely that for the state pension, that the negotiations with the rest of the UK over the divorce agreement, it would seem to be quite an easy thing to agree on, that the Scottish Government takes over the UK state pension. Strictly speaking, in international law, under the continuing state model, which the UK has already specified that it intends to follow, and without any discussion or debate about that, then the assets and liabilities of the current state go with the continuing state. But I think there is no national insurance fund. It never has more than about 15 billion in it, which is about 1 month's spending. So it's funded out of taxation, and the national insurance money is collected. I know you're going to tell me that taxes don't fund spending, but as far as the public is concerned, they're paying national insurance and then they're getting it back in their pension in due course. So the Scottish Government is obviously going to be the one collecting the taxes, and I think therefore they can quite easily, it would be fair that they also take over the payment of the state pension. And of course, they have the central bank, so there's no problem about how do we pay for the state pension, because they just tell the bank to pay however much is required. On the other hand, for the private pension sector, and I think it's worth saying that it is existing SNP policy to increase the state pension to the European average a relatively short period after independence. So that would take the Scottish universal state pension up to about £300 a week instead of the current £160, which would make private pensions less important for the average person. But for the private people who do have a private pension or a company pension, then there's going to be various scenarios. If you are a pensioner for a big, UK national or multinational company, such as, say, British Airways, they're going to pay the pension in sterling. And I think that it's unlikely they're going to start giving you Scottish pounds. Their number of Scottish pensioners would be quite small relative to the number of UK or outside UK pensioners. They'll just carry on paying in sterling because that's what the contract is between you and your previous employer, and it'll be up to you to convert that into Scottish pounds. If you're a pensioner for a Scottish pension fund, such as, say, one of the local authority pension funds or the Scottish Government pension or the police or NHS or something like that, those are already managed in Scotland. That they will be paid in Scottish pounds. If you have a private pension or some sort of money purchase scheme or things like that, then it would be up to you and the provider as to what happens to it. So I have a small pension plan with Aviva, for example, which is a company based in Norwich. I suspect that they may not agree to provide a Scottish pound version of the plan, in which case I'd have to accept that it's staying in sterling, and that any withdrawals I make from it would be in sterling. If you were a pensioner with, say, somebody like Scottish Widows or Standard Life, they're based in Scotland. I don't see any reason why they shouldn't offer to switch your fund into Scottish pounds and then pay the pension in Scottish pounds. Some companies, outside Scotland, which do a lot of business in Scotland, may offer that facility as well.
Mm-hmm. Okay. So just to clarify my position on the taxes don't fund spending thing is, the way I like to say it is taxation is the mechanism by which the government is allowed to spend. So one of our first episodes, in fact, our first episode was about, this is a few years ago now, was about Professor Murphy's short blog post about the way national insurance is conceived is undermining the NHS by design, like the way the rhetoric around it. So the idea is when you go, I pay my national insurance so that it pays for all this stuff later on. And basically, eventually, politicians get to go, yeah, but don't you want better value for money? Don't you think the private sector will handle this better? And it's just a way to sort of like make the case for privatization when you think you're paying into it to get a return on it. So that's where I think what now people are interested in monetary sovereignty and a sovereign currency for Scotland might be an opportunity to make that case or get people to understand how the spending really happens when you receive your state pension, instead of this sort of relatively recent myth that you're just paying into a savings account and they're paying it back out again when you retire.
If you are going by the fund model, then what's paid in national insurance just about covers what's paid out in pensions. It certainly doesn't cover the NHS spending.
Yeah, of course. I just think that pensions are a problem area in people's thinking, in that perhaps in my parents' time, or certainly in my grandparents' time, people probably understood that the state pension was being provisioned by people who were productive, not people who had previously been productive and had saved up their money. It's transfers going from people who are productive to people who are now, because they've reached an age where we've decided as a culture, it's time for you to take a break, retire. They're now not productive. Whereas people understood it was a social compact, whereas in the 80s, it kind of all got confused and it was all about, well, you don't really deserve a decent fun retirement unless you've saved up some money.
I tell people, and usually cause consternation by saying that it's impossible to save for a pension.
Yeah. Likewise, it's impossible to save up enough money in case you get cancer or something. It's impossible.
Well, the only way you could save for a pension, you could genuinely save for a pension, would be to fill the garage with tins of baked beans and packets of loo roll, because everything else involves a transfer from those in work at the time. So, if I want a car in 2050, it's going to be built by somebody in 2050. I haven't saved up a car which I then bring out of packaging and unpack in 2050. So the only way I get my pension is by taking a surplus off what's being produced, and taking it away from those in employment at the time. You can take the money out of the picture entirely, because it just confuses matters.
Yeah. I think that's really what I'd like to get back to, is to get people to understand that it's a social compact.
Yeah. Then you can understand that it's actually more efficient for the state to provide the pension, via the tax and spending system. Whereas if you do it on the basis that you're pretending that you're investing and then getting a return on your investment, and it's all done through the City of London and whatever, you're simply in a position where half the money disappears in fees and charges.
Yeah. Oh, yeah. It's an absolute gift to the fire sector, as it's called. But I also think if we get people to understand that it's a social compact, that really what we need to do is develop a culture where we talk about, okay, so what are people entitled to? What kind of because that's really going to determine how retirees live out their life. What our actual culture thinks is, well, this is reasonable. People should have this reasonable standard of living. Retirement shouldn't be punished with...
No, well, what you need to do is to ensure that during your productive life, the 40 years or whatever, that you and the rest of society are making productive investments which will increase the size of the cake, such that once you cease to be productive, those who are taking over won't mind giving some of what they're producing to you. At the moment, for the last 30 or 40 years in the UK, we might have made some investments, but they're mostly financial engineering. They're not productive. They're not growing the UK economy or ensuring that we're sort of all geared up for climate change or whatever. So given that sort of scenario, we may find that, in 2050, when we're being flooded and burnt and whatever alternately, that those who are still struggling to keep the economy going, are not very happy about providing an affluent retirement for people who are not contributing anything anymore. I think one way I visualize things, if let's say imagine if I get to 67 and retire, and the next day everyone under the age of 67 drops dead.
Yeah.
Then the fact that I've got, I'm Fred Goodwin and I've got £15 million in my pension fund is not going to help me, because there'll be nothing to buy and there'll be nobody to look after me or do the jobs that need to be done. So my financial, my guarantee that I've got all these savings which are going to ensure my comfortable retirement is worthless, because it just doesn't work.
And that kind of goes back to that testimony that circulates on social media around this issue from Alan Greenspan, where he tells Paul Ryan, look, there's nothing to stop the government creating as much money as it wants and paying it to someone. The real challenge is, are the real resources available for sale at reasonable prices?
Yes.
So that said, question 17 on your FAQ sheet is, don't we need, and by we, I guess you mean Scotland as a nation, don't we need to save up foreign exchange reserves before we can introduce the Scottish pound?
No, we don't. And this is one of the tests of the Growth Commission, simply tells me that they haven't a clue as to what they're talking about. So the reserves, the foreign exchange reserves, would be automatic, and they come from issuing the new currency and the fact that it has to be paid for with the old currency. So effectively at the end of and there's a little bit of a sort of inflow and outflow, because we will be handing in sterling to purchase the Scottish pound. There's a certain outflow because some Scottish pounds will go in the other direction to buy sterling to repay sterling mortgages or so forth. But at the end of the day, the Scottish Reserve Bank will end up with something like probably 50 or 60 billion, which is basically the reserve balances at the Bank of England, which Scottish banks currently hold. So that money, for example, the Royal Bank of Scotland has 27 billion on deposit at the Bank of England. That would be converted into Scottish pounds. So the 27 billion would go into the Scottish Reserve Bank's account at the Bank of England and sit there as part of the foreign reserves of Scotland.
Great. Number 19, I've been told the banks will have unmatched assets and liabilities, and that this will cause a big problem. Will it?
No, this was something that the These Islands anti-independence group have been on about, but that won't happen. What will happen is that the sterling balance sheet of the bank would shrink as the money gets exchanged into the Scottish pound, while the Scottish pound balance sheet would go up. But the assets and liabilities in the Scottish pound part of the bank would match each other, as would the assets and liabilities in the sterling part of the bank. It's worth saying, I think, perhaps, that the banks which wish to operate in Scotland after independence, let's say take something like Sainsbury's Bank, it would need to divide itself into a Scottish subsidiary and a rest of UK subsidiary. So there'll be Sainsbury's Bank Scotland plc and Sainsbury's Bank UK plc. And all the sterling accounts would be transferred into the IUK part of the bank, and the new Scottish pound accounts will be in the Sainsbury's Bank Scotland part.
And that kind of goes to that short piece that you wrote about, will the banks leave Scotland? And so people really need to understand what, for instance, RBS Group is, in that it's not a bank. There's different components to it. Do you think you could just run through that for people who are concerned?
Yes. Well, I mean, this was sort of much bandied about by the anti-independence side prior to the 2014 referendum. There's a fundamental misunderstanding for most people. You talk about it's now the NatWest Group rather than the Royal Bank Group, but it is a group. It's a group holding company, and it owns less banks now than it used to, but it simply owns a number of banks. So the NatWest Group own Coutts and Company, which is the Queen's banker. They own the Royal Bank. They own the NatWest Bank. They own the Isle of Man Bank. They own Ulster Bank and probably various others as well. They used to own things like Citizens Bank in the United States. And these are all separate, independent, they're legally independent companies. They file their own accounts, they pay their own tax bills. And it was never the case that, for example, in the financial crash in 2008, that one country would be responsible for the entire lot. So in 2008, the Royal Bank Group owned Citizens Bank in the US, and it was the US Federal Reserve that regulated and bailed out Citizens Bank, not the UK. So if Scotland was independent, the only part of the NatWest Group would be Scottish registered and under the jurisdiction of the Scottish Reserve Bank would be the Royal Bank PLC, which is about 11% of the NatWest Group. It really doesn't do any business outside Scotland these days. What was the Williams and Glyn's branches in England have mostly been closed or converted into NatWest branches. So the Royal Bank PLC is approximately a £91 billion bank, so a little bit under half Scottish GDP. It would be perfectly manageable for the Scottish Reserve Bank to regulate and, if necessary, provide emergency funding for the Royal Bank. And that's the only bit that it's responsible for. If something happens to NatWest Bank, that's London's problem.
Got it. And you round off your FAQ sheet by addressing the claim that the commercial banks will face huge foreign exchange risks. Could you talk about that?
Yeah, well, this is really to do with the loans that they have. So the fact that we have the 75 billion of sterling mortgages, for example, those loans would be in the IUK part of the bank, along with any sterling balances, the savings accounts or current accounts that we've kept in sterling. They're not unmatched, and there's no foreign exchange risk because everything's sterling in that bank. Similarly, with the Royal Bank in Scotland, everything will be in Scottish pounds, so they don't face a currency risk either because they don't have any lending in sterling. It would be all in Scottish pounds. So there simply isn't a big foreign exchange risk.
Okie doke. Now, I'm just going to talk about a question that we got from a listener a while ago, and it might be a short answer to this one, but apologies for the long run-up. So we had a question come in from a listener called Max Peterson, and he asked me, I was wondering if you had any info on how borrowing works between the devolved countries and Westminster. Now, in his case, he's in Wales, and he quoted an article from businesslive.co.uk entitled, "The Welsh Government is Significantly Underutilising Its Borrowing Powers." And in that article, it says, under the Wales Act 2014 and 2017, the Welsh Government has the ability to borrow up to £150 million a year for capital via the UK government issuing of gilts through the National Loans Fund. It also has the ability to borrow £200 million a year for resource expenditure, which it has never used. And he finishes the question by asking, he's mainly curious as to whether or not Wales pays the money back if it borrows. And now my take was, yes, it's a loan from a currency issuer, the UK government, to a currency user, the Welsh government. So that loan will be outstanding until it's paid back. But I wanted your take on that.
Yes, it would be. And the Welsh government would be in the same position as a Welsh local authority. Mm-hmm. And I expect that a lot of Welsh local authorities would have outstanding loans from the National Loans Fund. Back in the 50s and 60s, early 70s, council houses were usually built by local authorities using loans from the National Loans Fund. And, they are charged an interest rate and they do have to pay them back. I don't know what the current interest rate is, but it's, it'll be relatively low. It's probably going to be something like 2 or 3% if you took a new loan from the National Loans Fund. I mean, it's fairly expensive compared to the rate that the UK government pays on a gilt. So the Treasury is making a profit, if you like, on the borrowing at 0.5% and then lending at 2.5%.
And of course, a profit that it doesn't need.
Yes. Well, they do according to their model. But obviously, if the Welsh government takes advantage of the borrowing, it does reduce their future spending powers because they'll have a loan repayment to pay. But if they're currently paying out on things like PFI, if they built a new school and then financed it on the sort of PFI hire purchase sort of never scheme, they're probably paying interest rates of, maybe 8% or 10% or something like that as part of the PFI scheme. So it'd be much better economic sense for them to borrow from the National Loans Fund to the maximum available and try and minimize all this sort of financially engineered PFI stuff.
Mm-hmm. Do you know, is that a similar arrangement between the Scottish government and the English government?
Yes, I mean the Scottish government has similar limited borrowing powers. I think they're allowed to borrow 500 million a year, and I believe that they do take advantage of that, and borrow the full amount.
Mm-hmm. So before we sign off, I'll just re-emphasize that we're having this conversation and you've done all this work because many of us believe that a nation being able to issue its own currency is key to an independent Scotland being able to have the full spectrum of policy options available to it, including full employment and a just transition to a green, sustainable economy. And maybe the first steps on that journey towards real independence, as opposed to nominal independence, is having enough people out there understanding the importance of Scotland issuing its own currency. So with that in mind, for people who want to get enrolled in that journey of understanding, where should they go? What should they be reading and paying attention to?
Well, I would invite anyone who's interested to join the Scottish Currency Group on Facebook. You should find it fairly easily, and you just have to apply to be a member before you can see the articles and the posts and so forth. If you just want to find out generally about the Scottish currency plans, then go to reservebank.scot, which looks like the website for the Scottish Reserve Bank, which of course Scottish Reserve Bank doesn't yet exist, but that has all the sort of information, blogs, all the text for the question and answer paper that you've been using today. It has recordings of talks by me and others about the issues and plans and so forth. So that would be a good starting point.
So that's great, Tim. So for more information, join the Scottish Currency Group on Facebook. Tim, it's been great to talk to you. I hope as things evolve for Scottish independence and the new Scottish currency, you'll come back and give us updates. Dr. Tim Rideout, thanks for joining me today on the MMT Podcast. That was the MMT Podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month and get access to patron-only episodes. You can do that by going to patreon.com/MMT Podcast. You can also find me on Twitter at MMT Podcast, and you can find Patricia on Twitter at Patricia N. Pino. And you can email us at mmtpodcast@outlook.com. Thanks for listening, and we hope to hear from you.